This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers the risks and returns that are involved in investing. As smart investors, we must attempt to minimize our risk while maximizing our returns. We all deal with risks on a daily basis. Commuting to and from school and work causes us to take some risks. We know that we could be involved in an auto accident, yet we still continue to travel to and from school and work. Why? Because we've determined that the reward is greater than the risk, and the risk level is therefore acceptable. With investing, we must make similar risk-reward determinations. Some risks are worth taking, while others are not. Some amount of money may be invested in a risky investment with the prospect of a huge return. But we may not want to allocate more than a small percentage of our total investments to such risky investments. Everyone has a different tolerance for risk. A colleague of mine worked for over 40 years, each year putting away money for retirement. She always bought ultra-low risk government bonds. She couldn't imagine taking the risk of investing in the stock market. She's now retired and is living a very nice life. Had she invested in stocks, she likely would have had more money now in retirement. But that doesn't mean that she should have invested in stocks. For her, the peace of mind of having her money in safe government bonds was worth the trade-off of very low returns. You'll have to make the determination for yourself of the level of risk you're willing to take with your investments. Most people will choose a mix of somewhat risky and mostly safe investments to reach their financial goals, but that investment risk mix isn't right for everyone. There are many risks to consider when investing. We will consider 4 types of risk in this chapter: market value risk, individual investment risk, purchasing power risk, and career risk. Some of the best advice you're ever likely to hear is, choose a career you love, that you're good at, and that pays well enough for you to live the life you desire. It sounds simple and intuitive, but you would be surprised at how many people don't seem to do it. I suppose it could be tempting to choose a career because of the pay alone. Making money is good and will help you reach your financial goals. However, when you stop to consider that most of us will work for 40 hours per week for over 40 years at our careers, doing something for the money alone seems a lot less attractive. For example, working on an oil rig in the ocean pays very well. For some people, it makes a fine career choice. For others who dream of starting a family, having evenings free at home, and working in a pleasant environment, it's a poor choice. Think carefully about your career choice, as it will have a major impact on your life in more than just financial areas. Our author makes a good point about careers these days requiring you to stay on top of your training and education. For most of us, learning is a lifelong process. If we ever stop learning, we may become less valuable to our organization and put our jobs at risk. Purchasing power risk is the risk that over time inflation will eat away at the buying power of the money we have. The Federal Reserve has a target inflation rate for consumer prices of 2% or below. So even if inflation is tame, it is still eating away at our buying power. And we must consider that at various times, historically, we've had inflation that has gone way beyond 2%. Even 2% inflation can add up. A 2% inflation rate that holds steady for 25 years eats away 39% of money's buying power. We should consider this when we make our investment choices. Although the stock market tends to produce decent returns on average, there are times when it does not. The above chart is the average annual return for the Standard & Poor's S&P 500 index, which is comprised of 500 different stocks. You can see that for most decades, the average annual return, sometimes called the compound annual growth rate, was pretty good. Who wouldn't love an average annual return of over 17% in the 1980s, or over 18% in the 1990s. But there were some decades where the average annual return was low or negative. Take a look at the 1970s return of 5.8% and the 2000s return of negative 1%. The chart here shows the S&P 500 index since 1950. You can see that the S&P 500 grew significantly during that time, but had a bit of a roller coaster ride in the 2000s. That roller coaster ride is what scares some investors away from stocks. They can't accept the volatility and the chance that their investments will lose value. There have been and will continue to be periods where the stock market declines in value and loses money for investors. Still, most investors are willing to accept the risk of loss in search of good returns. From 1950 to 2009, the S&P 500 index has returned 11% on average if we assume that dividends were reinvested. That period of time includes some time frames where investors took big losses, sometimes even over 30%. Those investors were rewarded for staying in the market. Of course, we cannot know what the future holds. But if we're seeking returns that outpace inflation, the stock market has been a good investment in the past, and we hope the same holds true of the future. This chart shows how an individual investment may not perform well even when the overall market does. In such a case, we would suffer from individual investment risk. The blue line is the return of the Standard & Poor's 500 index from March of 1971 to early 2011. You can see that money invested in the S&P 500 index returned in total over 1,200% during that time. The red line is Navistar, the company mentioned by the author. Navistar did not earn any money for investors during that same time period, but instead lost a lot of money. Before you get too discouraged, let's take a look at a chart that includes a company I'm sure we're all familiar with. This chart shows Walmart from March 1971 to early 2011. It is difficult to see, but the S&P 500 index and Navistar are also on this chart. Walmart returned around 70,000% to investors who've stuck with them since 1971. That is around 70,000% compared to just over 1,200% for the S&P 500 index. This chart illustrates that while it is possible to pick a loser like Navistar, it is also possible to pick a huge winner like Walmart. This chart illustrates an important concept. Timing isn't everything, but it is very important. It may be difficult to see, but this chart covers March 1996 to early 2011. Guess what? Navistar had the best return with just over 500%. Walmart came in second at about 400%, and the S&P 500 index was just over 100%. So Navistar was a terrible investment if we consider the time period of 1971 to 2011, but was the best of the three options from 1996 to 2011. Investing can be risky, but we can reduce our risk by employing a few strategies. First, never invest in anything that you haven't thoroughly investigated. Investing wisely isn't easy and requires you to do your homework. We'll cover things you should research before investing in later chapters. Second, diversify. That means don't put all of your eggs in one basket. Why? Because it is possible to put all of your eggs in the wrong basket. For example, Navistar in 1971 through early 2011. If we had done that, we would have lost money. If we had diversified by buying lots of different stocks or investing in an index fund, we'll cover index funds like the S&P 500 index later, performed much better. Third, consider your time horizon. Are you 25 and investing for retirement? If so, you can afford to take on quite a bit of risk because you can ride out even huge market crashes and probably come out with good returns in the end. Are you 55 and planning to retire at 65? If so, you'll want to pare back your risk a bit and diversify your investments. As we approach retirement age, it is important to sell some of our riskier investments like stocks and buy safer investments like bonds. We'll take a look at a good ratio or mix of stocks to bonds later. Finally, the author mentions that we can sell investments that we believe are overpriced. You can't really time the markets, but you can tell that you've made a lot of money on an investment. It may be wise to consider selling some of those big winners when they are priced high and looking to pick them back up for the long term when they drop to a lower price. Walmart is a good example of a company that tends to go through cycles. Let's take a look at a chart of Walmart to see what I mean. This chart shows Walmart from early 2001 to early 2011. Take a moment and look at the peaks and valleys. Notice that the two highest peaks are over $60, while the valleys seem to fall to around $45. Some investors, but certainly not all, might choose to reduce their risk by selling all or some of their Walmart holdings when it gets near $60 per share. If they employed this strategy, they could have sold at $59 3 different times in 10 years and picked the stock back up at $47 each time. Of course, they could not have known that, and past results do not predict future performance. Still, many investors, myself included, tend to employ some version of this strategy, and at least in my personal case, it's worked very well. Beyond stating that savings and bond returns are generally very poor, and stocks, real estate, and small businesses can typically be expected to outperform savings and bond investments, I don't want to say too much. Why? Because we can only consider past, not future returns. And the choice of stock, real estate, or small business investment and the timing of that investment are huge determinants of investment returns. Our author does a nice job of covering this topic in the text. He is certainly very bullish on stocks, real estate, and small business investment, and lukewarm or worse on savings and bonds, as am I. But you must make your own decisions. You want to be comfortable with your investments. You want to be able to sleep at night. You want peace of mind. As I mentioned earlier, my colleague was never comfortable investing in stocks and kept all of her money in government bonds. Was that a mistake? No, absolutely not. Sure, we can look back and see that she would likely have had better returns in stocks. She was happy with her investments, had complete peace of mind, and did achieve her financial goals, though. Read the book, view this video and the others, but take what you get from all of it and make it work for you. If that means investing in stocks, real estate, and or a small business, great. If not, as long as you save and invest, you'll be headed toward a better retirement than people who completely ignore planning for retirement. One last thing before I sign off. I know you're busy. I know you have a lot of classes, work, a social life, and many obligations. I also know that you will only get out of this class what you put into it. To get as much as you can, read every word of this book. It is a great investing primer. It starts by assuming that we have no knowledge of investing and builds from there. Few things are as important as your financial well-being. The more you learn, the better you'll be at investing and the closer you will come to reaching your financial goals. So be sure to put aside enough time each week to get the readings completed. Over the years, I bet you'll be glad that you did. That is the end of this presentation. I hope you enjoy reading the chapter.